Mona, are you surprised at the strength of the market, particularly the cyclicals and the value stocks over the last couple of days, in the light of not having a full stimulus deal from Congress yet?
Yeah, look, we were talking about your traditional pandemic playbook. That included, large cap technology, gold, softer U.S. Treasury yields, and really high quality investment grade bonds. What we've seen over the last few days is, in fact, that pandemic playbook is starting to soften. There hasn't been a real catalyst for it, but what we're looking for broadly is for this S&P rally to be sustained. As Mike said, you do need to see a broadening out of participation. In order for that to happen in a sustained way, we do think there should be some sort of shift in fundamentals too, whether that's better virus trends, which we are starting to see, whether that's, the arrival of a vaccine solution, which, we have several players now in phase 3 of trials. We're also looking at higher yields today and really over the last week, which also is supportive generally of cyclicals. And then, broadly speaking, we're looking at, as you mentioned, the stimulus bill. And I think for the most part, the market is sanguine about this. They maybe have liked what President Trump has done, but more importantly, they're probably expecting Congress to come together, as they always have in the past, perhaps in a very late-minute fashion, to provide additional stimulus, which does put money in the hands of consumers. Households also provides additional PPP for the small businesses as well. So all things that could ultimately help this cyclical rally.
And there's earnings also, just to bring up to add to your list. Mike, Foot Locker is one that I just wanted to note today because it did close up 8%. It came out with a huge surprise today. They said they pre-announced same-store sales for the quarter up 18%. Analysts were expecting that number to be down 24%. They also indicated they're going to be profitable, also something that wasn't totally expected. So, either analysts are just completely wrong in the absence of guidance and not, calculating. They had a good tell with Hibbett Sports saying 70% same-store sales growth a few weeks ago. But anyway, it's either the analysts or companies are just doing a lot better, or there's a lot more consumer confidence and optimism out there than maybe people expected.
Yeah, or companies and analysts assumed the worst and didn't really expect there to be a quick pickup during the span of the quarter or just afterward. Clearly, some of those $1,200 checks went toward sneakers, and the market is now recognizing that. Although I have to say, if you look at, for example, on a price-to-sales basis, Foot Locker, it's still down near the lows of the 2008, 2009 recession, meaning the overall market is not expecting there to be much of a sustained move higher. Obviously, secular issues here with the whole business model. But I do find it interesting that you can have this big uptick in expectations, and people say, wow, what a windfall it was for this company. But still, they're in a relatively distressed position. And so when we talk about a rotation into value might be something like Foot Locker as opposed to cyclical, which could be, high quality industrials that are selling things around the world.
And just to your point, Mike, the company attributed 2 factors to the strength: stimulus checks and pent-up demand. Both of those things are temporary. So, Paul Hickey, I wonder how many companies are getting sort of a temporary boost by those 2 factors that will go away after this quarter.
Yeah, I think a lot of a lot of consumers are getting that extra benefit. That was the intent of the program when it came out, and it essentially worked. The key now is, will there be enough? Will the bridge be long enough till people are comfortable coming back to work? That remains to be seen. When it comes to like a company like Foot Locker, it was, as you said, it wasn't a thriving business before the pandemic, and it wasn't thriving during. And it's not thrive. It probably won't thrive after. But it gets to the point when companies don't provide guidance, the deviation between actual results and estimated results by analysts gets a lot wider. So you're going to tend to see that a lot more because companies weren't giving guidance in the first quarter earnings season. Hence these results this quarter that are just off the charts relative to expectations. Earnings beat rate is near the highest since going back to 2001. Sales is well above average, and the higher percentage of companies have raised guidance this quarter than we've seen over the last close to 20 years in a given earnings season. So it's very strong because there was a lot of negative sentiment heading into at the end of the Q1 earnings season, and so we're starting to see that play out now. So but it's all a matter of how things play out from here, and unfortunately, none of us have a crystal ball as to how the virus is going to take and what Washington's going to anticipate, and then how those two are going to work together.